An AI just tracked a private jet to front-run a billion-dollar corporate takeover. Before Wall Street investment banks announce massive corporate mergers, executives fly across the world in private luxury jets to finalize terms in secluded, off-the-grid locations. But human discretion no longer guarantees corporate secrecy. Sophisticated hedge fund algorithms are harvesting global ADS-B flight telemetry, satellite radar, and regional airport fuel manifests in real time. These automated neural networks cross-reference high-altitude flight vectors with corporate executive registries, predicting multi-billion-dollar acquisition announcements days before press releases hit public wire services. For decades, corporate mega-mergers were negotiated behind closed doors in private airport hangars and isolated resorts. When top-tier executives meet, millions of dollars in market capitalization shift in an instant. Today, however, an unseen artificial intelligence network tracks every flight path, altitude change, and transponder signal broadcast by private aircraft. By parsing raw aviation radar streams through predictive location models, algorithms identify anomalous rendezvous points, such as two corporate jets landing at a tiny airstrip in Omaha or Zurich, and instantly calculate the mathematical probability of an impending buyout or hostile takeover. This is not speculative journalism. It is an automated multi-million-dollar arbitrage strategy running continuously across global quantitative funds. By detecting executive flight patterns hours or days before regulatory disclosures are filed, institutional algorithms position massive long trades in target company stock. When the acquisition is officially broadcast to the public, retail investors rush in, driving up prices and instantly handing huge profits to the automated algorithms that saw the flight path coming. Welcome to the relentless world of aviation surveillance finance, where signal data beats insider secrecy every single time. The raw infrastructure enabling this automated surveillance relies on open-source flight telemetry known as Automatic Dependent Surveillance Broadcast, or ADS-B. Commercial and private aircraft continuously broadcast their unencrypted location, airspeed, and altitude to ground receivers worldwide. While corporate executives pay government aviation agencies to keep their aircraft tail numbers off public tracking websites, quantitative hedge funds deploy independent networks of physical ADS-B radio receivers surrounding remote regional airports. They capture raw radio signals directly from the sky, completely bypassing official flight tracking registries and privacy blocks. Once raw telemetry signals are captured, machine learning models process the unencrypted radio packets into structured flight vectors. The software correlates these movements with corporate jet registries, SEC ownership filings, and executive housing records. If a pharmaceutical titan's corporate jet suddenly flies to a small regional airport near a niche biotech firm's headquarters, the neural network flags the trip as an anomaly. The algorithm does not care about official press statements. It measures physical distance, ground dwell times, and repeat flight frequencies to build a statistical map of high-stakes corporate negotiations. Furthermore, these systems augment radio telemetry with high-resolution synthetic aperture radar satellites. Satellite imagery pipelines scan airfield parking aprons, measuring vehicle density, ground crew movements, and hangar activity in near real time. When an executive aircraft lands at a private airfield, computer vision algorithms immediately analyze the surrounding tarmac, identifying rental vehicles or secondary executive jets present at the facility. By combining spatial radio signals with orbital visual data, the AI constructs an undeniable visual log of clandestine corporate meetings long before a single non-disclosure agreement is ever drafted. Translating physical jet locations into profitable trading orders requires immense computational reasoning. Once an anomalous flight pattern is flagged, specialized quantitative algorithms evaluate historical corporate transaction data. The neural engine analyzes past acquisition behaviors, board member personal networks, and balance sheet cash reserves to quantify the probability of a merger. If the mathematical probability crosses a strict statistical threshold, the system automatically triggers options orders on equity exchanges, acquiring leveraged call options on the target firm while maintaining total anonymity across dark liquidity pools. Consider the multi-billion-dollar merger between major energy conglomerates or tech titans. Days before investment bankers draft official press releases, executive flight paths intersect at private airstrips in Texas or California. The AI detects the synchronized landings, calculates a 94% statistical likelihood of an acquisition, and begins executing micro-trades across decentralized order books. By accumulating shares in tiny fractions to avoid moving the market price prematurely, the algorithm builds a massive front-running position while human traders remain completely oblivious to the private meeting taking place thousands of feet below. This multimodal data fusion represents the ultimate evolution of alternative data trading. In past decades, quantitative analysts physically counted cars in retail parking lots or hired spotters at shipping ports. Today, artificial intelligence ingests millions of global movement vectors per second, synthesizing satellite radar, jet transponders, mobile location pings, and corporate filings into a single cohesive predictive interface. Human intuition cannot compete with a machine that monitors the physical coordinates of every corporate leader on Earth simultaneously, transforming real-world geography into an algorithmic yield engine. The proliferation of jet-tracking AI highlights a widening economic divide between institutional funds and retail investors. While everyday market participants rely on published financial statements, quarterly reports, and television commentary, institutional algorithms trade on physical reality hours before news reaches public feeds. By the time a corporate merger is announced on financial news networks, the algorithmic funds have already captured the majority of the price surge. Retail investors who purchase stock after the press release are essentially buying at inflated prices created by autonomous systems. This dynamic creates an environment where traditional fundamental analysis is routinely rendered obsolete by real-time spatial surveillance. An investor analyzing a company's price-to-earnings ratio is fundamentally operating in the past, reacting to quarterly data that is months old. Meanwhile, institutional machine learning platforms monitor executive flight coordinates, supply chain logistical hubs, and corporate infrastructure changes minute by minute. The institutional edge is no longer about superior valuation models or economic theory. It is about sovereign access to high-velocity alternative data feeds that track real-world physical actions. Moreover, attempts by corporate executives to evade tracking are increasingly futile. Corporate legal teams often register private jets under shell companies or trust entities to conceal ownership. However, graph neural networks easily bypass these administrative obfuscations. By analyzing historical flight destinations, refueling schedules, passenger manifests from secondary municipal airports, and executive calendar cross-references, the AI maps the true owners behind anonymous shell corporations in seconds. There is virtually no physical movement across global airspace that can escape modern quantitative surveillance. Regulatory agencies around the world are struggling to respond to this technological frontier. Traditional insider trading laws were written for human beings exchanging confidential information in secret. But when an autonomous neural network infers an upcoming corporate merger purely by tracking unencrypted public radio signals and satellite images, no law has been broken. The system uses publicly broadcast physics and data telemetry to make mathematical predictions. Consequently, financial regulators find themselves legally powerless to stop algorithms from front-running multi-billion-dollar corporate transactions. As artificial intelligence models become increasingly sophisticated, the tracking of private aviation is expanding into maritime shipping, mining operations, and semiconductor supply chains. Algorithms now monitor cargo vessel drafts using satellite radar to calculate oil volume movements before official trade balance figures exist. Physical reality itself has become a giant readable database for algorithmic capital. In this high-tech financial landscape, those who control the spatial surveillance data pipelines will continue to extract value from markets long before the rest of the world even realizes a deal was made. Subscribe to stay ahead of the machines.